Good afternoon, everyone. We're just waiting for the final attendees. We've got people streaming in. We're about to kick things off. Hold on to your seats. Should be about a minute or two. Just a quick sound check. Can anyone hear us?
The audio. Let's expand audio. Yeah. Above dashboard. I'd like to expand.
That's it there. I think we just look. It's like. Huh? Guys, just about to kick it off right now. Just testing sound one more time. Okay. We're hitting the road now. What we've titled this webcast is How We Intend to Maximise Returns for 2017. I'm Nicholas Forsyth and I'm joined by James Gerish. James, thanks for joining us after I'm sure what was a very busy day.
Thanks, Nick. Happy to be here.
Fantastic. So let's kick things off. We've been keeping everyone waiting a couple of minutes, so let's kick it off now and get straight into it. Firstly, though, just some housekeeping. As always, you will need to use the sound on your PC. If you've got a set of headphones or are already wearing a set of headphones for better sound, go for it. Remember, you can ask questions via the toolbar. We've got a little bit of time for Q&A at the end. If we don't get around to answering it, we will be late here this evening, so you may receive a call from someone from the office to answer your question. Also, as well, we will be recording a version of this, and we will have a recorded version once we finish the webinar that will be made available to everyone that attended. So keep your eyes out for that. That email should be sent later on this evening. If you somehow do not manage to get it, feel free to call us. Obviously, disclaimer, remember that the information in this presentation is of general nature only. It does not take into account the investment objectives, financial situation, or the needs of any individual investor. Before making any investment decision, we recommend that you consult with your financial advisor. Okay, so just quickly on the topics that we're going to cover here today. You may have seen this in the invite. Topic one, and investors out there, we may jump around a little bit. That's just due to the fact we're in the middle of the reporting season and there may be a little bit of back and forth, but I think you will get our message strong and quite clear by the end of it. But firstly, we're going to cover, will global equity markets peak in 2017? I guess that's the question on everyone's lips. Secondly, where are Aussie interest rates heading and what does it mean for property prices? 3, resources, which commodities do we expect to outperform? Topic 4, gold versus the US dollar, which asset will outperform in 2017? Topic 5, the big 4 banks, which most people own, do they have more room to run? Topic 6, what is the best way to approach this volatile market. Topic 7, which is kind of linked to the bank's question, but not quite. High yielding income stocks as safe as they used to be. Obviously, with Telstra the other day, copying a 4% clip over the years in a day. And topic 8, reporting season, 3 stocks that we're looking to buy or may already own for anyone out there that's not a member. Okay, so first question, James, is will equity markets peak in 2017? As I said, question on everyone's lips. What you guys have been looking for is...
Hang on, Nick, I'll stop you there because BHP's result has just dropped a couple of minutes ago, so I was out just before 5 o'clock. So you look at you look at what's happened with BHP over the last 12 months. It's been obviously a massive performance on the upside for BHP. They've delivered their result, which is pretty much beat on every expectation. So EBIT's up, which is earnings before interest tax, net profit up, taxes up, dividends up, and debt reductions up. So, we sit here and look at the markets every day, Nick, and we talk about all these nice things about whether the market will peak or things, but things change pretty rapidly in markets. So, BHP looks like a really good set of numbers. It looks like it's beat expectations on all metrics. The one thing I would say, and just looking at the numbers pretty quickly, the market was focused on all of these things. They were primed for a good result. The only issue that I've got there is in capital management. So there was expecting some type of jawboning around capital management going forward. So whether there was the intent to increase the dividend, pay a special dividend, share buyback, etc. And the company said this: with several of our commodity exposures currently trading above our long-term forecasts, and with considerable economic and political uncertainty ahead, our bias remains for lowering debt reduction. So, what I'd take from that is that BHP are not going to launch any more aggressive capital management programs, which the market could have been anticipating. They're going to have a bias for paying down debt. So the result was better. It was above expectations on the majority of metrics we look at, but that lack of capital management might be a disappointment for BHP. So initial glances were out a couple of minutes ago, but that's my first thoughts there, Nick.
Do you think we had a potential target on it of 24.50? Wanted to buy it there. Do you think that opportunity won't happen now based on that result?
No, I think that's the thing. So, markets were primed for a good result. The markets were primed for beating on the majority of metrics. I think the outlook guidance is the key for BHP. The fact they're not going to launch capital management, anything substantial around capital management. We didn't think they would actually outline a program in explicit detail, but we thought they'd talk about it. So probably not. I think, BHP, the risk reward in BHP at these levels doesn't stack up. We're looking for lower prices before it goes higher later on in the year. So, no, don't buy BHP here.
Okay, fantastic, James. What I want to do is I want to set the scene again for this first question. The question is, will equity markets top out in 2017? Now, Aussie market, short term, we called it up to 5.8. Obviously, a lot of stocks going ex-dividend today over the coming weeks, which will probably mean money comes out of the market. You've called the market down to 5.750 shorter term and saying, post a breather, up after that. What are you seeing here?
It's not a big call because, we're at 5,800 now. You look at the futures don't take into consideration dividends. So we're going to lose 50 points out in the next month in dividends. So the market, futures are trading above that 57.50 mark now. So, the market, although I do think that the market is going to go up to, 5,800 we're at now, we expect a breather over the next month before a push up to 6,000, and then we've got to be a little bit more cautious on stocks from there on in. If you think about the US market, I mean, we've rallied 250% from those GFC lows. The Aussie market has, rallied 60-odd% from those GFC lows. So we've had a massive run up, and we haven't had a major correction therein. So, it's always difficult to predict when a correction or a major correction will happen. We've put it out there. We're saying a 25% correction at some stage. And that's not a big call. If you think about it, that's only putting the market down to the 2016 lows. So, people will jump on the back of that and say that it's a massive call, but it's not. So market's correct. That's the natural flow of markets. and that's why we're predicting that at some stage in this year, Nick.
Okay, just got a few charts here. Just wanted to identify some levels. First of all, we got the SP 500. Currently, this was yesterday's chart, so I haven't been updated for today, but the market was closed, obviously.
I think it'll be the same then.
Yeah, assuming it will be the same. Now, what's the level we're calling on this? 23.51. Do we think that can get up towards 25 or more?
25 before, right now we're in a pause on the market. So the market's been this, they've been focused on what Trump is doing. They've been focused on the massive infrastructure spend and big fiscal stimulus that's being rolled out in the US. So the market, looks 6 months down the track. So that these things will lead to a stimulated economic growth, etc. So, that's what we've seen the market play out at the moment. We're looking for a pause in the short term, a push up 6 to 7% higher from where we're trading at now, and then that'll be the time to get more cautious equities. And I think that the biggest thing that we've got to be conscious of from a trading perspective, investment perspective in 2017 is the market. We've had a great start to the year. Markets don't traditionally run up all year. They simply don't go up in a straight line, and that's what we've got to get our heads around as investors and grapple with. The Australian reporting season has caused some volatility on the individual stock level, and that's what creates opportunities. The index, would be that, we'll move as the index does. So we're looking for some consolidation now, higher prices before it comes back, and then, a deeper correction at the end of the year.
Okay, James, just wanted to tie the product in here as we look at the other charts. We've got, the SP 500 Daily. We were just looking at the SP 500 weekly, so similar charts. We've then got the DAX and the DAX weekly. Then we've got the ASX. Now, our service is geared around proper capital allocation, real money in the market, and we also, go to high levels of cash in times of uncertainty or in times when we think the market is overbought. Now, if we do see that sort of 6,000 level, what sort of cash levels do you think we'll be moving to?
Pretty high. I guess one of the things that really frustrates me about the investment community, I've worked in this area for a very long time, Nick, and there's always, the broker reports are always bullish. They're always predicting higher prices that may or may not be achieved. There's always, I sat back at the start of this year penning our 2017 outlook piece, and I went through all the broker expectations around where the index is going to be at the back end of this year. And everyone sticks their finger in the air and looks for 10% growth. They look at 5% capital growth and 5% dividend yield. And, it's not, the markets, markets traditionally do about 8%. So that's why they go for that 10%. They go a little bit above what the market traditionally does. But, markets don't go up forever, and we've got really volatile periods in markets. And I think, we've been through a period where we haven't had that volatility. We haven't had those deep corrections. Last year we had 12% correction at the start of the year, and then we had a positive year overall. So I think it's that, that shorter term mindset around what the market will do. Don't get over optimistic when everyone else is getting over optimistic. Don't get overly pessimistic when the media is getting overly pessimistic, and take a measured approach around it. And understand that markets go up and down, and they can do so in some pretty severe circumstances.
Yeah, I'm sure all the investors out there watching have had an experience with a broker in the past where you just got to look at the way these guys make their money. They pump the market, and at the end of the day, they've got to sell the market to be a happy, wonderful place. And even if it doesn't go up, they've got to imply it does go up a lot of the time. And that's how our competitors make money, I must say. So we're probably one of the only services out there that actually tells you when to preserve capital, when to sit in cash, when to go to higher levels.
Well, we're looking at the absolute return. So we're not looking at our returns versus the index. We're not looking at, how our portfolio is going versus the index. Of course, you'll reference the index of why it's doing a certain thing. But at the end of the day, we're looking at absolute return. We're not having to, have the fully invested like a fund manager needs to be fully invested. We don't need to, have those adherence to those mandates. So at the moment, we're 20.5% cash. We're in sell mode rather than buy mode. The market comes back another 50, 100 points. We'll probably put some of that cash to work, and then we'll go to a lot higher levels of cash if the market pushes up to 6,000, because simply we don't think the rally that we've seen in the start of this year as sustainable.
Okay, so just got the ASX here, just to reiterate, a bit of a breather shorter term to 5,750, maybe even slightly lower, push up towards 6,000 where we'll be doing a bit of pruning, taking some stuff off the table, because, I guess if you look at this move up all the way from the day that Trump got in, it's been quite a substantial move.
It has, but you've also got to look at the individual stocks you're holding. So one of the things we've been writing about in the reports is about targeting some of those unloved areas of the market. So some of those things that are cheap relative to other plays in the sector, some of those things that have been whacked in 2016 that represent reasonable value. Henderson, that's been an uncomfortable trade for us. But, it started to move up today. It was up 3% today. Vocus was up 6% today. These are highly uncomfortable trades for us. But it's about positioning where we are now for the next 12 months. And, not buying those things that are hitting the headlines, not buying the Domino's pizzas 30% ago. That stock's down a massive way. Brambles is down 30% for the year. All these much loved names have been hit really hard when the majority of brokers out there have been positive on them.
And still are to a certain degree.
Yeah, but they'll fall on their sword at the low. That's what typically happens.
Definitely. So what we've done, what we've got now is topic number 2. Here we're talking about where Aussie interest rates are heading and what does this mean for property prices. I guess we'll just touch on this. We're not necessarily property guys as such. This was something that we cast our view on in the Outlook piece. We don't want to polarise people that have done well on the property market, but we do have a bit of a view. Obviously, it's maybe slightly biased, but just kicking off initially to the US rates, monthly chart, and then we've also got the RBA rate. I think the most important one is obviously the RBA cash rate for the property prices.
Domestic property prices are, but global asset prices are priced off what the US is doing. So bond rates, bond yields have started to rally. So if you think, it's probably not going to come to as a surprise to a lot of people out there that, the higher cost of capital reduces should reduce the price of an asset. So if you can borrow at 3%, you can afford to pay more for an asset. If you've got to pay 6% for your capital, it reduces the price you'll pay for that asset. So, everything being equal, higher interest rates means property is going lower, but that'll be dependent upon different areas of the market. So supply and demand is a really big factor, etc. So I'm no property expert. I own property. I'd like to sell it because I think it's pretty high at these levels, but you got to live somewhere, Nick.
Yeah, and I guess probably whether you touched on supply and demand before, a lot of supply in that apartment market. We'll see what happens there, especially in Melbourne and Sydney.
We listen to I sit through numerous presentations with a lot of the property companies, Stockland, Mirvac, Abacus, all of the large property companies in Australia, and they're not experiencing anything. They're not experiencing anything in terms of issues around defaults. The banks, bad debts. The banks have gone through a reporting cycle. Bad debts are incredibly low, but the regulators have been extremely harsh on how they're suggesting that banks tighten up their credit criteria. So we're not seeing credit growth, even though prices are going higher. Look at Genworth's results. They're the most leveraged property play in the market. So they've got their top line is declining because banks don't want to take on high LVR loans, but delinquencies are rising, particularly in Queensland and WA. So Genworth, if you want a short out there, Genworth's probably it for mine.
Yeah, what's that at, about 280 now, 270?
It was down about 5% today.
Yeah, and it was down, what was it, 12% on the result day? So, not a good one. So the next one, we're talking about the resources space. Which commodities do we expect to outperform? We've got a few charts in here, but first one that we're kicking it off with is just oil. Now, we've been in and out of oil stocks, and what we say at Market Matters, what we've always said is, obviously resource-based stocks, price takers, not price makers. We did actually pick the low in iron ore stocks, buying Fortescue at $1.50 at the start of last year. Probably should have held it for a bit longer with the benefit of hindsight, but that's Hindsight Capital, best performing fund in the world. First of all, we're kicking it off with the crude oil weekly chart. Now, we've sold Origin at about $7 recently. Hasn't done too much since. I guess that chart looks relatively bullish. Looks like it's sort of pushing high. What's our view on oil at the moment? Obviously, a lot of these commodities are probably mutually exclusive, but oil first.
it's about risk reward. So when you approach a commodity in a stock that's linked to the underlying commodity, you've got to look at the risk reward of that trade. So when oil was trading around $30, $35 a barrel, we were expecting somewhere around the $60 a barrel by year end. We're at 53.45 as the chart shows there. So the risk reward doesn't stack up. So we had Origin in the portfolio, made a good turn on Origin. But we're not there because it doesn't stack up. Why would you be there for the final $7 push higher in oil? So over 2017, we're not shy. We don't shy away from making bigger calls in the market. We're predicting a $40 to $60 oil price, and you can say that's a pretty big range, and it is, and I can see that it is. But the oil market's a pretty volatile market. I was having lunch today with an oil trader who was saying something similar. So $40 to $60 in oil. If it's a 53, 54, then you probably sit on the sidelines from oil stocks. If it goes back down to 40, you probably jump on the buy side of oil stocks. So just you've got to take a more active bias around the underlying exposures you've got.
Do you think the bit of a side question, but Trump, some of his policies around oil could affect the oil price, could put a little bit of pressure to the downside on it, or these things take a long time to come into fruition, and you could almost argue that his hands are tied somewhat?
I don't think his hands are tied at all. I don't think there's only a few circumstances his hands would be tied, I think, but that's probably in the past. Oil is going to be, the price of oil is dictated by the level of supply, and the level of supply is dictated by the price that it's trading at. If oil is low, there's no incentive. There's nothing. No one's incentivized to bring on new production. Oil rallies, then new production is incentivized to come on stream. So you talk to BHP. So it's almost capped.
Yeah, the price is sort of capped. The more and more the price rallies, the more and more supply will come in.
You talk to BHP. They bought a lot of onshore oil assets over in the US when the prices were high. Prices dropped, and all they're doing, and we sat with the CEO there. They've been drilling wells because that's what you need to do in the US to maintain your land. So you drill wells and then you chuck a cap on it, and you wait till prices come back up. And when the prices come back up, you take the cap off and start selling the oil. So that's the nominal thing. That's the normal thing that happens from a commodity perspective. We see it in crude, we see it in iron ore, we see it in a lot of other commodities globally.
Okay, so we said in this chart as well, we said a close over 52, which we've seen, could see us up to 60, but as you've said, it's a tough one to call. Probably will trade in a wide range this year, but the trend shorter term at least looks like it's going in the right direction.
Oh, if I'm having a punt, I'm seeing oil up to 60, but when it's trading at 53.45, the risk reward isn't there. If I'm wrong, we're getting the last little bit out of oil, and we're always looking at things from a risk-reward perspective.
Okay. Next one is that's back to the oil price, but next one is the iron ore price. Now, that's currently gone even higher overnight. I think it's around 93, 94 now. Now, our view on the iron ore price, as I said, we were buying the likes of Fortescue last year when that iron ore price was in the 40s, not quite at 38.30. It's rallied a lot since then. What are our thoughts on the iron ore price, where it's going?
So below 30, we're targeting 70, and it's gone to 90, so it's far exceeded our price. And I think, we're now short Fortescue Metals. We're short around $7. It's gone up a bit above that today. So, the stockpiles, I should say, of iron ore have been rising. What normally happens is that stockpiles increase ahead of Chinese New Year, and they deplete after Chinese New Year. So, they've obviously been rising. The iron ore price has been rising. The Chinese economic trends have been positive, but no, we don't expect that theme to continue. So, you've got to take a position that's going to be, out for the next couple of months, and not necessarily what will play out today, tomorrow, or the next day. That's really gambling. We've got to have a position that we're happy with over the next couple of months. In our bearish Fortescue position, we've gone out to May to encapsulate the bearish scenario that typically plays out in that month. So, no, iron ore has exceeded our price forecast, but you've got to be negative iron ore in my view at the moment.
Yeah, definitely, and it's definitely sort of decoupled from a lot of other commodities, hasn't it? Like it's just got to a point where
the commodities overshoot on both sides. They go further up than you expect them to, and they go further down than you expect them to. There's not many out there that would have anticipated iron ore from 30 to 90. I was in a presentation with Andrew McKenzie from BHP, who was very bearish on iron ore at that level. Prices were going to stay lower for longer. They haven't. They've simply rebounded. And I think the key takeout here is that you need to, even the companies themselves don't know where the commodity prices are going, and that's why it's so difficult to invest in commodity companies. So we're more active traders of them.
Okay. Next thing we've got is just the materials index. Just touch briefly on this. Looks like it's had a really good, obviously, run through 2016. It's picked it up again in 2017. Do we think this space in general is due for a correction? We've gone through reporting season. All of these companies reported well. We bullish materials, or are we just expecting a pullback?
No, pullback from here. So it'll follow commodity prices. So commodity prices have been really strong. Analysts have upgraded material stocks. So on the ASX, all the earnings upgrades, we're looking for 18% earnings per share growth in the ASX 200. All of that is being driven by the resource companies. So if commodity prices come back from here, there'll be less earnings growth in the ASX 200. Material stocks are near enough to the peak. They don't stack up from a risk reward perspective for mining. So we don't have them in our portfolio. The only thing we're looking to buy them on a pullback, and we're looking to add another gold exposure in the portfolio from here.
Okay. Now we've got the BHP chart. We talked about BHP chart, and we're pressed for time. We've already,
losing momentum. Yeah. So the result today, a great result, like Rio's result. Rio's result was a great one last week, I think early last week, but not enough to push it to new highs. So everyone's pretty optimistic resources now. So we're on the sell side when everyone else is optimistic. That's our mantra.
Okay. Speaking of the sell sid, we've also got the Fortescue chart here. You talked before about a bit of a short on Fortescue. Pushed a little bit higher today on the back of the iron ore price moving higher. Was that a bit of a double top forming there around the 7 and the reason for the short, or we just think it's...
Yeah, we've got an options trade on it, so it's always hard to go against the grain. So we've put a short options trade or a bearish options trade at $7. It means that the upside is capped. Sorry, the downside is capped. So we're looking for 5.75 on the downside. It means we can lose the options trade we've put on. You can lose 50 cents, but you can make 75 cents. So we've got $7 put options long and 5.75 put options short going out to May. You can make $1.25, but it's cost you 50 cents, so you can make 75 in the middle. So, clearly we think it's going down, whether it's, but we've capped our liability if it doesn't.
Okay. Fantastic. And
$6 target though on Fortescue.
Okay. Okay, next topic, we've got gold versus the US dollar, which asset class will outperform in 2017. And we're kicking it off with the gold, with the actual underlying gold price. So currently around that 12.30 mark. We are talking this year that we do have a pretty bullish gold target of about 14.50. You just want to step us through, the reason for that gold target and how we think that'll play out.
Okay, so gold right now, US dollar's been pretty, a little bit muted. We're still looking for a higher level in the US dollar. So gold is somewhat muted in the short term. So look for the US dollar index, I should say. So the US dollar index, for those that don't know, measures the US dollar against a basket of its major trading companies, partners, I should say. So US dollar index going to 105 before rolling over. Once the US dollar rolls over, then gold can go up and retest that 1,400 an ounce, and that's when we should be getting exposure to the gold companies. So we've got Newcrest in the portfolio now.
Kick that one up.
And we'll likely add, so we've got higher levels that we see in Newcrest. We bought that around,
22,
I think it was...
bit under 22?
No, 21.
21-ish, yeah, around there.
So we've got that in the portfolio. We'll look to add another gold exposure once the US peaks out around 105, or US dollar peaks out around 105.
We've got a couple here. So we've got, first of all, we've got Evolution, and the next one we've got Regis. Regis we've actually bought and sold 2 or 3 times very successfully. I think our compound returns well over 60 or 70% over the last couple of years. But yeah, we've never bought Evolution as market matters. I'm sure you've bought it yourself.
Yeah, I like Evolution. I probably like Evolution more from a company specific point of view. Evolution's got that. It's got really good assets, and it's expanding the mine life of its assets. So, Evolution to me is a great company, and it'll continue to do well. It's a really low-cost producer. It's around, like anything, you've got to pick your timing of when you buy something. So, US dollars makes one more high, then we go and buy another gold stock in the portfolio.
Okay. And the way you're talking about it, target of 14.50. If we get the timing right, which we have in the past, it could be the investment or the trade of the year.
It's massive upside in gold. So we've seen a couple of things. You touched on the material index before. One of the things is around price realisation. So the coal companies, the iron ore companies, etc. We see the iron ore price at 92. We see the coal price rallying over the last 12 months. But they're not, the companies operating in that area are not achieving those prices. Coal companies are contract pricing. They're not achieving what the spot pricing have had. So, and I don't think they're achieving what a lot of analysts were expecting them to achieve. Gold companies, on the other hand, have been experiencing higher prices than I think analysts have expected them to achieve. So, in the very short term, I think the momentum is struggling a little bit. If they make a higher low, as the US dollar, I should say, makes a higher high, that's when you want to go in and buy gold stocks.
Okay, and also as well, we've got Regis here. What we probably will do, by the sounds of it, is buy a bit of Evolution. If the opportunity presents itself, we may forego Regis this time around, but I guess at the end of the day, given that we like gold stock, we probably will cover it for our members out there.
We'll talk about it. We'll definitely talk
and we definitely will talk about it in the reports moving forward. Now, we've only got about 10 to 15 minutes left, so we will start to quicken up the pace. We've got topic 5, and we're talking about the big 4 banks, so they have more room to run. First one we've got is just the banking index, which just shows you the good run it's had recently and the bounce from December up until now. A bit of a consolidation at the start of the year, then it started to go again. But yeah, want to kick it off with CBA. We last averaged CBA at about the 82.60 mark, currently at at 85 odd, paying $1.99 dividend soon. Now, how much more room have these things got to move to the upside?
I think they're range trading. So we've got two banks in the portfolio plus Suncorp. We've got CBA and ANZ, 8.5% in CBA. We think it goes, it's going to pay an $2 dividend in the not too distant future. So it's going to be, its ex-dividend price is $83.91. So you've got to trade the range, I think, in the bank. So $80 to $90 on CBA will be the range trade. For my clients, I've sold $87 call options out to May. You picked up about $1 on those. You can probably get a little bit more now. And range trading those. So it's got to be, you've got to present a strategy that is not, you don't think CBA is going to go to $100 anytime soon. We're not in that market. The market's been running extremely hot for an extremely long period of time. You can see from CBA that the range previously was $70 to $80. You can see it from March of last year to December of this year. December of last year as well, $70 to $80. It broke out of that range. And when it broke out of that range, it ran up to 85 and then came back and retested 80. So the $80 level is now key support in CBA, and we're now at 85.91. So look to trade the range between $80 and $90 in CBA.
Yeah, fantastic, Dan. I think that encapsulates the value in the service. While we kick over to the ANZ chart just quickly, in that a lot of SMSF retirees get our service. They don't necessarily go blow for blow with it or mirror it. However, if we're telling them the ranges of the banks, which people sometimes have 60% of their SMSF tied up in, that gives them empowers them and gives them the ability to sort of trim some off the top at certain stages, or even, like you hinted at before, maybe do options if they do have the capacity to do that.
Okay, so look at the ANZ chart there. So we've had 3 major pullbacks in that upswing from June of 2016. We had 333 decline, we had 282, and we had 323. Stocks move in ways that they've moved in before. So that's what technical analysis does. So we're not all technical, we're not all fundamental, but you look at the sectors that we want to be in, and then we look technically about when we should be buying those sectors and the stocks specifically to those sectors.
Okay, so the next thing is, what is the best way to approach this volatile market, which is, I guess, exactly what you're talking about at this point in time. Now, the chart we've got is Star Group, which I guess is not necessarily encapsulating the way to approach the volatile market, but it is a stock that we bought recently, which I'm sure you've got, which I'm sure you can talk about. Look at that low 465. We picked it up at 475, so almost the the low for quite some time. Got as high as 632. Was dragged down with what happened to Crown, etc. For investors out there, is this one that you could still buy? What are you seeing here?
Yeah, it is. It's still a traded ex-dividend today, so that's why it was down a little bit today. No, you've got to buy pessimism and sell optimism in a volatile market. So a volatile market basically means that the market's going to be range trading. It's not going to be trending. A volatile market, you don't just willy-nilly buy pessimism. When a stock drops, you don't simply go out there and buy it. You've got to have an understanding of the earnings profile of that company. Brambles was a good example yesterday. So to answer your question, we would buy Star now. Star is something we think that over the next 6 months it's got a really good earnings profile. The market got too bearish on it, etc. Brambles yesterday came out with sort of a second downgrade in a couple of weeks. It's still trading around 18 times. It's not cheap, and there's management don't have any clarity around its future earnings. And that's a stock that I looked at it for a long time yesterday morning, whether to pull the trigger and put an alert to buy it. We didn't because we wanted to maintain our cash levels above 20%. There was a lot of uncertainty around Brambles going forward. It seemed like management didn't even have a handle on their earnings going forward. They downgraded earnings 3 weeks ago. They've now had another downgrade of around 2% on the day of their earnings release. So, it seems like they don't have a handle on their business, and it was something we stood aside from.
Okay. Next stock we've got a bit of Henderson in here. Now we have got this stock. It's had a couple of good days. It's had a really good bounce over the last couple of days. 350 seems the key support level from there. It's gone quite hard. I guess for people out there that maybe own the stock or maybe considering buying it, didn't report great, but there is a merger in the pipeline. What are your thoughts on this one?
Yeah, it didn't. You're right. It didn't report great, but it's what the market's expecting. So, the market was incredibly bearish on Henderson. They reported numbers that were pretty much in line with expectation, but the outlook was pretty dire. I was on the conference call with the CEO, and he was pretty negative around fund flows. That said, I've heard it all before. CEOs get very pessimistic on their businesses at their lows. That's the nature of the beast. So, we've seen Henderson up another 3% today. That price there that you're seeing on the chart there is from yesterday. So I look at Henderson as trading on about 13 times. It's a global fund manager, UK orientated, merging with Janus later this year. I look at Platinum, which is trading on 14.5 times, which we also own. I look at Perennial, which is trading on 16.5 times, and I look at Magellan, which is trading on 20 times. Relative valuation, Henderson is there. There's a lot of bad news baked into that cake. So for me, Henderson's it's higher risk, but it's a buy at these levels.
High risk buy, targeting a move back over $4.
$4.50.
Okay, fantastic. Okay, next topic we just want to talk about, and this sort of is tied into the banks a little bit, but not quite. A high-yielding stock still as safe as they used to be. Now, a good way to kick this one off is Telstra. Now, we've been pretty bearish on Telstra. Haven't owned it since we last sold it at 540. Did call it down to 475 or 450. We've pretty much seen that play out. Said it's got no growth. I guess now at 484, and you rush in and buy this thing with a dividend looming for a bit of yield, or do you just give it a wide berth?
484, it's going to have 15.5 cents dividend go out of it. So, you're going to see it lower than that. 450 is probably our target on the downside. I don't mind the lower, Telstra at 450 I like. It's paying, grossed up 9% yield. But you'd want to have an option strategy over the top of it. So you'd want to be selling puts to buy it at lower levels. And once you've been put the stock, then you can sell calls over the top of it. So you can probably extract 10, 12, 13% out of Telstra very easily on an annual basis. So no, it's a stock on our radar, but I'm not holding the stock because I like the stock. There's risk around it.
What do you think happens to that stock if that yield, put it this way, if they don't get growth over the next few years, if earnings decline, that dividend goes lower, doesn't it, and that stock price goes back even further?
Oh, they're not getting any growth. So, I mean, they had the dividend was 15.5 cents. EPS over the period, or under normalised EPS, was 14.8 cents. So, they're borrowing $1 billion a year to pay their dividend. So, they're supporting that by the lumpy NBN payments, which they can do, and they're at no risk of on their dividend, but that doesn't go on forever. The NBN payments peter out in 2020, so they need to fill that gap by buying other things.
Okay.
And when you go out there and buy other things, it's a risk.
Okay.
Or it can be, they might buy something cracking and it changes that company. So, you've just got to be. Telstra's not the bond that everyone thinks it is.
Okay, next one's car sales. Our assistant that puts these charts together, I don't know why he's popped this one in here because it's not linked to the yield story, but may as well pick your brain on it anyway. Car sales, what do you think about it around here? Obviously in that tech space, disruptive, hasn't had a very good couple of years, but you a buy down here?
We'll have to get rid of Dennis. No, I'd be short car sales. I think high PE, the earnings profile is at risk over the next couple of years. We're targeting $9 on car sales. They did report well from a headline number, but the underlying trends in that business are weaker. So great company, great dominant position, but it's the best days are behind it in my view.
Okay, we're running low on time, so let's pump through these last 4 or 5 slides and give the investors out there watching something to look at or something to buy moving forward. First of all, we've got Wesfarmers. In our Outlook piece, which most people out there probably read, we did call this year a $35 price target on this. It reported, okay, I remember you covered this for Livewire last week on the Friday video you did. Very, very complicated business model and how many business units it's got. What are we thinking here? I guess the text on this chart says the failure of 46 remains challenging for Wesfarmers, but what are we picking to move lower short term?
Yeah, so good result. Top line was better. So top line earnings were better. Dividend was better, but the underlying trends in that business were weak. So if you think about Coles, which is about 40% of earnings, Coles like-for-like sales were 1.3%, but that's down a long way from what it was prior. Woolies is the big behemoth in that sector, and Woolworths has been cutting prices. Woolworths reports tomorrow, so we're going to have a really good handle on what Woolworths are doing and the impact it has on Coles tomorrow. Bunnings, the jewel in the crown, like-for-like sales growth of 6.9%. That's down from around 8%, so that business is still growing, but its growth is slowing. So all in all, if package it up in 2 words, is that it's going lower, I would think.
Okay.
Good top line result, but the underlying trends in that business.
Do you think investors out there will ever be able to just own Bunnings as a separate entity one day, or that'll never happen?
No.
Okay, nice blunt answer there. So next one, Suncorp, we do own it. It's been in our portfolio for a while. It's actually our largest holding. Pays a good dividend. Went extra day, I think, 38 cents. At one stage, it had held the dividend. I think it sort of drifted off in the afternoon. Suncorp, we've talked about its correlation to the index. I think it's 1550 price target on it. Would you still buy it here, though? After the dividend?
Just going back to that question on Wesfarmers and Bunnings, people will say that there's Bunnings Warehouse BWP out there, but that's the underlying properties of Bunnings. It's not the actual operating entity of Bunnings. So don't come back to us on that in that regard. Suncorp, it's been a tough few years for general insurance and commercial insurance. QBE's been struggling as well there, and more on the commercial side. So 2 things. Like Wesfarmers, or pretty much the opposite of Wesfarmers. So Wesfarmers had a really good top-line result. The underlying metrics were weak. Suncorp had a weaker top-line result than the market was anticipating, but the underlying metrics were improving. General insurance prices are going higher. Interest rates are going higher, which improves their margins. Suncorp operationally, so they've got new management in recently, and they're improving how they operate the business. So we're happy holders of Suncorp. We've got a large holding in Suncorp, about 12%, and it's doing reasonably well for us, Nick.
Okay. Next one, we'll just kick off quickly on a Macquarie Group. Got as low as $80 recently when it reported. It's now bounced up towards 87. We've got a $90 target on this and probably will sell, I'm guessing. Risk reward's probably gone there for an investor out there looking to buy something, but if they own it, they could probably sell it with us because it's probably a good target level.
Don't buy it here, but sell it at $90.
Okay, so last topic we're kicking off with is reporting season. Here are 3 stocks that we're looking to buy, or may already own, or that are on our radar. We have already talked about some stocks that we are looking to buy, but the first one we've got here that did report today, which sold off pretty aggressively in the morning but rebounded at the end, is Altium. I guess in regards to that result, a lot of people like their business model. What are we seeing here? Do we still like the underlying business over the next sort of 12, 24 months?
Yeah, the report was reasonable today. It's on 30 times earnings, so it's one of those higher risk, higher PE stocks that everyone hates at the moment. But for those that don't know, they do printed circuit boards. They've got really good growth. They're $1 billion market cap company. They've got targets for revenue of $100 million with 30% margins. So, I guess the only thing that I looked through the result this morning. The stock was down 12%. And I thought to myself, where's the landmine in this result? And there wasn't a landmine in this result. So, I moved pretty quickly. It's a low liquidity stock. I bought some for myself this morning, Nick, and it ran up this afternoon. So,
for lunch.
Yeah, sort of. I think, I'm not concerned about this stock. So, if you want to higher growth, higher risk tech company, Altium is we're comfortable with it still after the report today.
You'd almost think some of these high PE stocks into reporting season, if you do want to pick them up, if you can pick through that result relatively quickly, it's maybe a good time to get them because they're almost being sold off by just direct fact they're a high PE stock, aren't they?
Yeah, but they've got a lot of had you read through the results and there's some sort of landmine in the results. So there's something about guidance or there's one of their products that's not doing so well, or they're growing the top line but their margins have been weak, or they've tweaked guidance and they've tried to put it under the radar, etc. So there's a lot of things that you need to look for in these type of stocks. So it's not a simple case of a high PE stock gets whacked, you go out and buy it. It's a case of why has it got whacked? If it's got whacked for certain reasonable point, then you can go out and buy it. And, there were some big lines going through Altium today. It's a low volume stock, but gee, there were some big lines of buying going through after it traded down to $7.30 odd this morning, closed back up above $8. We bought it before the result, a little while before the result at $7.95.
So still up one after today. Next one, Citadel. We've talked about this in the reports. Don't officially own it as Market Matters. I know this is one that you like, and I think you've got a $6 target on it or something. It's quite a liquid though, and that's probably the reason why we've erred on the side of caution. If we go and call this a buy, we could probably push it up. We need a liquidity event, don't we? So, thoughts on this one?
Well, you picked some speckies there for buys. It is a speculative stock. I like it. It trades by appointment. Yes, the result was good. It was a miss on the top line, but as I was saying around Suncorp and some of the other results, the underlying business is still performing extremely well. One of the things I look for is around margin. So, if a company can increase their prices or the increased price for services, and they can maintain, that will expand their margins, and you don't see it hit the top line incredibly, a lot. That shows a dominant market position, and then that company should do reasonably well going into the future. So. We don't own it, but I like the story. It's just liquidity is an issue for us.
A lot of long-term contracts in place as well.
And the management own a lot of the stock. So.
Yeah, that's what you look for. Okay, so the last one here is QBE. Now, this is one that we've done well on. We called it as a buy. We said you could buy it under 10, got to 9.23, was the intraday low, and, it looked like Trump was about to win the election. Now, it says on this here $12 minimum. We've already seen that. That was old text on the chart. Probably should say 14 now. But what are we seeing here? We are talking about the US dollar, rallying and then reversing. Does that mean we're short-term bullish QBE but look to take profits over a certain level?
If you've got a short-term perspective, you probably take profits on QBE. Now, we bought it closer to 10, we're up around 20% on it. You could book profits in it. We think that you've got to have a few stocks in your portfolio that are longer-term macro plays. US interest rates go higher. Commercial insurance premiums have bottomed, and there's takeover speculation around QBE where there's smokeless fire. So, we distill all those things down and say we're comfortable still holding QBE, even though we're in a very good profit in the position.
Okay, so we've got to think of questions here, but we have gone over time. So what we'll do is we do have a handful of people still here, so we will call you individually and answer your questions. I guess lastly, for any information about the Market Matters membership, please give us a call on the 1300 number, which isn't listed here, but it is 1300-301-868. That was 1300-301-868. We are running an offer on the back of this webinar that you will see on your screen at the moment, but it is an introductory offer where we're taking over a 20% haircut on a 1-year subscription and close to about a 45% discount on a longer term 3-year subscription. If someone sees himself in the market longer term. If anyone has any questions, queries, comments about membership or anything like that, feel free to give us a call now. And I hope everyone enjoyed this broadcast. James, thanks a lot for your insights. Really appreciate it.
Thanks, Nick.
And we'll see everyone next time. Have a lovely evening.